So to get started, let me address the following question to John Cochrane. The recent financial crisis has brought to the forefront fiscal challenges. What are the consequences of fiscal policy in the U.S., England, and Europe for long-term inflation and growth? And all this in less than 10 minutes.
Oh, good, a raise. I thought I had 8.
Less than 10.
Okay, that's a really interesting question, Lars. Let me start. What I'm showing you here is the just to motivate the question. This is from the Congressional Budget Office. It's the projections for debt held in private hands, U.S. government debt, and their best estimate is the one that goes up to the moon. This isn't some crazy right-wing think tank. This is the CBO. So that frames the question for us. It says debt held by the public. What if the public doesn't want to hold that debt? I don't want to talk today about Greece, which finally did default and the world didn't go under, Italy or Spain. Let's talk about the bigger question. Is this our fate, the U.S., the U.K., and European leaders? It's not necessary that we should have a big sovereign default, but Greece and company are a preview of where we might go if we're not careful. So there's no one to bail us out. The question for us is, do we pay it off, do we inflate, or do we default? And we need to think about that. Now there's nothing like having a whole audience full of University of Chicago alumni, because they know that we can only address this sort of thing with an equation. But that's in honor of Milton Friedman. I thought I'd bring that one up. Unfortunately, that's not the equation we need today. An equation. You're usually not allowed to do this in public, but there's nothing like a University of Chicago alumni, so I can. So let's ask the question, is 100% debt to GDP ratio sustainable? What does that mean? Now think about it, even 100% is remarkable. That's six years of federal income. You couldn't pay off 6 years of your own income as debt. How in the world do governments do it? And the answer is growth. So the calculation I made here is the minimum payment, if you'd like, to keep your debt from increasing. If you don't want your debt to increase, you have to pay the interest rate times your debt every year. Governments can grow. Debt to GDP won't grow if GDP is growing. So as you can see, the equation is that the interest rate minus the GDP growth rate times the debt to GDP ratio has to equal the surpluses. And you do have to run some surpluses one of these days. So how does that work, for example? Where did you get 100% debt to GDP ratio? Well, in the good old days, perhaps, you could have had a 5% interest rate, a 4% growth rate. That allows you to support 100% debt to GDP if you can only have 1% of GDP as surpluses. Maybe in the recession, interest rates went down. That's good. Unfortunately, growth rates went down too. But still, 1% surpluses could support 100% debt to GDP ratio. Problem, of course, in the U.S. is we have negative 10% surpluses, and that seems like it's going to last forever. That can't work. And the big worry for all of us, what keeps me up at night, is interest rates will sooner or later recover, but growth doesn't seem to be recovering. Well, then you have a 5% on the left-hand side and a negative 10% on the right-hand side, and you're in real trouble. The answer is growth. Yes, and we need to fix the surpluses, but with the surpluses at least only have to be mild positive numbers, not years and years of paying it back. We need growth, not a quarter of growth, not a year of growth, not this last month's jobs number, not a year or two of stimulus, but the kind of growth that goes on for decades, the kind of growth that only comes from productivity, ideas, new businesses, and people. That's what pays off debt. Now, my second fear, these are graphs I stole from John Taylor. On the left is GDP and potential GDP and actual GDP. The potential is just a trend line through the 1982 recession, and then you see the current recession on the right. We're still stuck 10% below trend and growing slowly. People like to look at the growth, but the level is what counts. Even that horrible CBO graph I showed you in the beginning assumed that we jump back onto the red line and then the red line keeps growing. Now, obviously, the danger for us is that we don't go back up to the red line and the red line enters a period of sclerotic growth, and then our debt problems really explode. Well, if it goes wrong, what does it look like? Here's another equation. I knew you wouldn't think we're serious if we didn't have some. Here I'm expressing that the value of the debt today is the present value of the surpluses that will retire that debt. This is back to the first day of your investments classes. That's how debt works, just like anything else. Let's think about what happens when markets wake up and decide we're not going to fix the long-run surpluses. As you can see, future deficits can cause inflation today. If S goes down, the P on the right-hand side goes up. That is if you're lucky enough to print your own currency. If you're Greece, future deficits go down and you have to default. The D on the top has to fall. But our danger is the inflation danger. Compounding it, if people give up on our long-run surpluses, the interest rates are likely to rise as well. Well, now you have two things kicking you. The mechanism here is short-term debt. People see bad times coming. If there was long-term debt outstanding, we could just have the interest rates rise and the market value of D on the numerator go down. But with short-term debt, that can't happen. And if you can't inflate, the only thing that happens is that the price level has to rise. So financial crises are always and everywhere a problem of short-term debt. It's a run. And like all runs, it's unpredictable. Politicians look at it and think it's a loss of confidence or illiquidity or speculators or something of the sort. This isn't a forecast. We can escape it. It's easy enough. But it's an earthquake fault that we're sitting on, not a forecast that it's going to rain next weekend. Well, let's talk about policy options. How can we avoid this? Where do surpluses come from? And here I just wrote out the equation a little more. Surpluses come from tax revenues, which are tax rates times income. And income is its current level plus how much it's going to grow minus spending. So with the three policy options people talk about are austerity. Austerity is austerity, stimulus, or growth. Austerity is raising tax rates and cutting spending. And the usual advice is a third tax rates, two-thirds spending. And as we're experiencing, it's not working. In Greece, Italy, Spain, maybe even the UK, the economies are tanking. Output's going down, so tax revenues aren't working even though tax rates are going up. And that's only current receipts. The real danger is the austerity spiral, where higher tax rates lower the growth rates, and then the future surpluses get worse and worse and worse. I made a little calculation that if raising taxes from 30 to 35% lowers growth by 30 basis points, then it raises no extra long-term revenue. Well, how about stimulus? Our friend Krugman and the New York Times think the answer for Greece is to spend more. Yes, believe it or not. Even the IMF says in the short run, spend more and then give me frugality, Lord, but not quite yet. The sort of the St. Augustine approach to fiscal discipline. The problem, of course, is where do we get the money? Nobody believes multipliers are 6, which is what it would take for it to be self-financing. The answer really is, well, when fiscal stimulus can't borrow anymore, you print it. This is the monetization, inflation, break up the euro and devalue approach. Embrace inflation, don't avoid it. I think this would be a calamity. We would need to double the price level to cut the debt to GDP ratio down to 50%. Capital flight, isolation, it would just be a disaster. So growth. Now, growth, I think, is the only one left. And I asked the stimulators, does it matter that Greece is the 138th best place in the world to do business? Or is the problem for Greece that the government isn't spending enough? The U.S., too, we're becoming a very highly directed government-run economy. We have a chaotic tax structure, all the disincentives of taxation and none of the revenue. So the IMF leaves this sort of thing to a breezy, oh yes, and in a few years down a structural reform program. Well, it's easy as a matter of economics. It's hard as a matter of politics, and maybe the time to do it is now. I'll close with an analogy. The economy is a garden, and it needs weeding and it needs fertilizer. It's time to weed the garden, all the little protections and problems in the microeconomy, as Large meant, they're the same thing. Weeding is hard. There's lots of entrenched interests that don't want to be weeding. It's not sexy. No great economist can come say, here's the latest fertilizer to pour on the garden. But the garden's had a lot of manure, and maybe what it needs is weeding for long-term growth, and that will incidentally be the only way to solve the debt problem. Thank you.
I'd like to open it up to the other two panelists. Would they have anything to add or subtract?
Or shall I start?
Please.
Well, on the one hand, the problem isn't quite as bad as all that. After all, the UK has got out of much higher debt ratios 3 times. We had a debt ratio of over 200% after the Napoleonic War. We had a debt ratio of 180% after World War I. We had a debt ratio of over 200% after World War II. And we got out of it without either having hyperinflation or destroying the economy. How did we do it? Well, it was a sort of mixture of keeping interest rates low, in part by financial repression, which was one of the things you didn't mention, which is undoubtedly coming down the way, in part by relatively low inflation, which was helped by the fact that after World War II, that everyone thought the problem was going to be deflation, and it took them about 20 years to wake up to the fact that the problem was inflation, not deflation, and it was in part by some growth, so you can do it. The problem, however, is in a sense worse, and I think that John actually mentioned for some of the Eurozone countries, because unless you do at least some degree of austerity and have some degree of plan for getting the deficit and debt down over the future, the markets are simply going to take fright and interest rates are going to rise relative to growth. So it's not only that growth is going to go down, but interest rates, because of the risk premium, are going to go up. So the poor old southern European periphery is going to get hit with both barrels, which means that the problems for them are a great deal worse than the problems for the US and the UK. I think John is somewhat overstating the horrors. I believe that in the US, if you could get out of political deadlock, you could actually solve your problems relatively easy. The problem in the US is a political problem, not an economic problem. The problem in the Eurozone periphery is far more difficult. And whether and how that will conclude, nobody knows, but you know better than I do.
Thank you for passing the hot potato. Look, there are a couple of things that spring to mind. The first is I can't retrieve from my memory any theory, but I'm here to be educated to suggest why we should go back to that growth trend that we were experiencing before the crisis. So, if that is a fact of life, we may repose all this in terms of a problem of debt overhang we see in Europe, we see in the US, and in the banking sector as much as in the government sector. So, assuming that the growth rate will be lower for a period of time as we work our way out, austerity or other regulatory changes, which I'm sure we'll talk about pretty soon, the question then becomes having dynamics that look pretty lousy, and that I very much concur with. So the question is really growth. So in that respect, my idea is that we're going to have a period of time, and maybe we're going through it right now in Europe and possibly also in the United States, where the markets won't give governments or banks the benefit of doubt whether they are going to restructure and improve that growth trend. And so somebody with the public hand will have to accompany that challenge. And so in Europe, we've seen a lot of mutualization of public debt, I think in response to this challenge. So somebody's providing the funding for Greece, somebody's providing the funding for Italy. And I think in the same way, if you look at the United States and you add up the amount of public liabilities that are now held either by the Federal Reserve or the brotherhood of central banks in Asia, then you can get a pretty big number. So the amount of duration risk that we in the marketplace have to manage is substantially lower than what we project. Can it continue? My answer is no. This will fix the debt overhang or accompany it. But I think going forward, I agree very much with Cochrane. It's a growth challenge.
John, the last word here.
I don't want to go on the record as not having said that spending isn't important. So the austerity of cutting government spending, especially needless one, I'm all for. What I'm worried about is the austerity of high tax rates with bad disincentives, as opposed to in the U.S., a lower rates, broader base in order to generate revenue. The decline in the growth trend, there are people, more and more people saying, well, you know, that trend in growth, we're not going there. And that's a real catastrophe. That's kind of what happened in the 70s. And then you don't grow out of your debt, which is what England did primarily, especially in the Napoleonic Wars. The bottom line is the micro versus macro problem. You know, those structural reform problems are awfully hard to do, but those are the only ways you return to long-run growth. And hopefully the bond markets would see that and give you a little more, because you talk about somebody's financing Greece. Well, somebody is the European taxpayer, and they're already at a couple hundred, 100% debt to GDP. Well, then it's the European Central Bank that's financing Greece, and we kind of know where things are going. There's no one to bail us out.